So again, Tim Condor, leisure analyst. I'm pleased to have John Duffy with us here. John, within the last year, sort of shuffled his titles around a little bit, sort of changed the F to an E up there, and added another piece there. And then Marshall's changed his title also, shortened it up a little bit. So, but gentlemen, thank you both for joining us. Thank you for being here. John, I think you maybe want to do a couple brief opening comments, so we'll do that and then go into some Q&A.
Sure. Well, thanks, Tim. And I also want to introduce, also with us is our new head of investor relations, Steve Pertel. Steve, if you want to stand up. So just a couple quick comments, and then we'll open it up to Q&A. But you know, as you think about this business, particularly this industry, it really is a great industry. It's an industry that's growing. It's an industry that has high barriers to entry. As you think about, particularly in the United States, where really all the markets are covered, and for someone to replicate a park like ours would cost hundreds of millions of dollars. So we don't see anyone coming in and building parks from scratch and competing against us. So high barriers to entry, and it's resilient in changes to the economy, and we've seen that over the last several years as we've seen changes in the economy. So it's a great industry to be in. We have continued to grow over the year, and I think we've got a lot of great opportunities to enhance that growth further. As you look at this year in particular, record attendance through the first 9 months, record revenue, record EBITDA. So we continue to grow, and you may have seen that we announced on our third quarter earnings call that we have deemed our Project 600 to be probable, and that's an aspirational goal that we set a few years back to get to $600 million of modified EBITDA in 2017. So we feel we have a very good confidence level that we can achieve that. So with that, we announced our new aspirational target of $750 million of modified EBITDA in 2020. And so that's a new aspirational goal, and I'm sure we'll talk a little bit about some of the drivers in terms of how we think we can get there. But we feel absolutely very good about this business. It's a great growth strategy. We've continued to grow the share price over the last several years. And on top of that, we have a great dividend. It's a dividend with a very attractive 4.5% yield. So with that, I'll turn it over to Tim.
Which you just increased a couple days ago by 10%.
We just sent out a press release actually last night increasing that dividend by 10%.
Well, I guess, John or Marshall, just maybe a little bit of a recap. I know in many areas east of the Rockies, there's some high heat indice issues. A couple of your competitors have talked about that also impacted things. But so from our perspective, that seems to set up a relatively easy comparison looking into next year in your most important quarter. So not necessarily a bad thing that you're through it. Would have liked to have the money, I know. But can you maybe talk about, if you look at your season pass visitation, the frequency that customer comes, and then I think you mentioned on the call that it really wasn't that customer that waited during the high heat indices. Maybe the mix there and how much of that could be made up in fourth quarter, and then your deferred and your season pass outlook here.
Sure. And I can start, and Marshall can add on. But as you think about the third quarter, it was a challenging quarter from this perspective of the weather. And in some of our markets, we did see excessive heat. We did see rain, much more than normal, and that did impact our attendance. But the beauty of our strategy around converting as many people over from a one-day ticket to a season pass is the right strategy, because not only does it contribute more overall revenue from that individual over the season, right, because they're spending more on a season pass versus a one-day ticket, and they're coming multiple times and spending money in each visit. But it is a great hedge against things like weather. So as we did see, some abnormal weather during really the busiest time of the year, one of the positives was that because we had so many season pass holders, we were able to, get those people to still come to the park. So really it was the one-day ticket folks that were the most impacted because of the downturn in the weather. We launched our 2017 season pass sales in September, and you probably have seen that, we were very pleased with the sales. Our active base of passes, which is a combination of season pass and memberships, was up 15% at the end of September. And in addition, our deferred revenue, which is a combination of the deferred revenue on those season passes plus our all-season dining pass, was up 28% at the end of September. So I think that bodes well in terms of our belief that we continue to convert more and more people from one-day tickets to season pass, sell more season passes to new pass holders, and our belief that this all-season dining is a great growth driver for us going forward.
Along that line, when the team first came in back in 2010, you were trying to start to grow season passes, and at different points in different parks, different times of the year. Can you talk about how maybe you'll raise pricing more, say on the single day, trying to push people to season passes, or different combinations thereof?
Sure, and typically what we do is we really want to get people to understand the true value of a season pass. And so what we've been doing is we've been migrating our one-day ticket prices up a little bit more than the season passes. So you're actually shrinking that gap between a one-day ticket and a season pass. So people are like, wow, I can buy for X amount more dollars, I can actually get a season pass versus a one-day ticket. The other thing that's been driving our season pass penetration is we've been increasing our investments in our tentpole events. So things like Fright Fest, expanding Holiday in the Park. This year we'll be up to 9 parks with Holiday in the Park. And our new Capital, where we have something new and exciting at every single park every single year that we're going out and marketing. So that gives people multiple reasons to come to the park throughout the year. And when they do that, the value of a season pass becomes very apparent to them.
Could you maybe, from a bridge or building the path to the implied 8% EBITDA growth to get to your 2020 goal, how much of it is your core business, North America, whether that be pricing, ongoing, different programs there, and then folding on top of that the international? Just sort of, the pieces to get to that average of 8% that would be implied.
Sure.
Well, so really what you said, in terms of the core business, it's going to be season pass sales and continuing to get people interested in the park with news in every park every year. Once they get interested, upgrading them into a season pass and continuing that growth like we've done really over the past 5 years and continuing now into 2017. Our all-season dining, which is a program we started a few years ago, where for a single price, somebody can have the ability to eat at our park every visit they come if they're a season pass holder. It's great perceived value for the guest. It's great for us because season pass holders historically have not eaten in the park, so we're getting a lot of incremental revenues at a great margin. The penetration rate, it's still a very young program. Penetration of our season pass holders is low. So as we grow that penetration rate, and part of the success we've had in the deferred income that John talked about a minute ago is the all-season dining. And so we're growing the penetration rate on a growing base of active pass holders. So you have those two, then you move on to pricing, which is a very important part. This year we increased prices in the mid-single digits across all ticket types, including season pass. And going into 2017, starting with our season passes for 17, and then our one-day ticket prices, we'll be doing the same again. And we think we have a long-term opportunity to continue to do that based on our prices relative to others in the industry. And then finally, and I think something that we feel very confident about when we take a long-term view is the international business. It's hard to say, and we've been fairly conservative about how we've talked about international. on a quarter-to-quarter basis. But if you look over the long term and you look at the pipeline of discussions that we're having and the new deals that we've gotten this year, we feel very good about growing that business and that being a significant piece of our business going forward and at a very high margin as well.
And if you think about all of those growth drivers that Marshall talked about, whether it be pricing, continued season pass penetration, our in-park, international, all of those are very high margin drivers. And so, we've got the highest margin in the industry today, and we believe that we'll be able to continue to take that up even further.
Can you just remind us of the parks that you've already announced agreements with? Dubai, China, Vietnam, just maybe where those are as they come into the stream also, and pre and post park opening, how much you get on a revenue and then an EBITDA basis, and then what some of your partners maybe have said their goals are in certain geographic areas?
So I'll start and I'll let Marshall talk about the financial aspect, but I have to tell you that we are extremely excited about this international opportunity. And as you think about this company and the value of this brand and how widely known this brand is outside the U.S., the fact that we have the expertise and experience in designing, building, and managing parks makes us an ideal partner for people outside the U.S. So our international strategy is that we will basically leverage our brand and our expertise. We will have no capital on our part. We'll partner with people that can basically fund, have access to the land. And so it'll create a very, very good, ongoing, high margin, very high margin revenue stream for us. The opportunities are tremendous. We've announced 3 parks, 3 deals to date, and that's to build 1 park in Dubai. We've announced 2 parks to date in China, and we've announced 2 parks in Vietnam. But as you think about the market, you take China, for example, where our partner there has talked about, many, many parks in that market. That opportunity is huge because, you have a growing population, a growing disposable income, and a lack of entertainment options. And we fit perfectly into that niche of the regional theme park space where we can build a park that is nearby these massive population bases in China. So we're extremely excited about China, and our partner is talked about the fact that he believes that we can do multiple parks there. And then even outside of those 3 countries, I think there are tremendous opportunities to further leverage our brand.
And then from a financial aspect, once we sign the deal, we make $5 to $10 million of EBITDA per year per park. And then once that park comes online, you make about double that, so $10 to $20 million per park per year. So it's a little lumpy from quarter to quarter, but from year to year, that's about what we'll make.
Should we assume that, given potentially some changes, hopefully for the better, in Latin America that we've seen over the last 6 to 8 months, that is an opportunity also, given population bases in certain countries, and is that outside the realm of reason?
I think Latin America, like a lot of areas throughout the world, I think Latin America continues to be, a good opportunity for us.
Okay. As it relates to cash flow, so we'll hit this from 2 angles here. One of the topic points that's been out there for a little bit is you've got NOLs, but you're going to exhaust those for good reasons, profitability being the chief of them among those. So you're going to exhaust those on the federal level by the end of 18, early 19, somewhere in that area. You got under the cutoff for the PATH Act, which eliminated the OPCO-PROPCO tax-free spin of the REITs. Filed your private letter ruling to the IRS, and on the call expressed good confidence in there. So I guess one question would be delve into reasoning for good confidence. Second question is, and we'll fold in the events of the last 24 hours, do you think that changes anything, positively or negatively?
Well, so we did talk about good confidence. The reason we filed the private letter ruling last year is because we felt like and we still feel like we have a very good case as to be a REIT, or to have part of our assets be a REIT. And so we have not heard anything to date to challenge that confidence. So we have not gotten a ruling back, and we're not sure exactly when we'll get a ruling, but we wouldn't have filed that PLR if we didn't have confidence that we had a very good case, and we still think that. John, you want to talk about the event?
Well,
did something happen last night?
Marshall, thanks for that, for throwing that over my way. But you know what? It'll be interesting to see how that plays out.
Okay. We do know that there is another company that we follow that had looked at REIT structures, and they started to go the private letter ruling route a little over a year ago, and then they hit the pause button because I guess once you initiate that, once you get the ruling, you're done, for better or worse. So we'll see there. Okay.
I will say, go ahead.
Yeah, that's actually, I mean, you can get a ruling and still not implement a REIT.
Right.
So,
right.
You know, getting the ruling doesn't force you into having to implement that.
But once the path is done and you get a ruling, the ruling's the ruling. Is that correct? And you can't modify it.
Well, the ruling's the ruling. You can't modify it, but you still make the decision as to whether you want to go down the path of a REIT or not.
Okay. But the good news is, though, we generate a lot of cash, and our dividend, which we talked about that we increased, we're committed to. We're confident that we can continue to grow it every year as we've done for the last 6 years. And once we become a taxpayer, we're confident that we can continue to grow and sustain the dividend.
So I guess just to round that out, under the worst case scenario, you don't get it. Talk about what you do with the cash, the availability, the check that goes to Washington. Then if you become a full cash taxpayer, where does that leave you as far as the ability to grow the dividend, the opportunistic side of the share repo, at least for a few years? How does that impact that?
Yeah, and as it relates to, you know, from the tax side, we would look at all kinds of things in terms of how we can become the most efficient in terms of having to pay taxes. So we'll start with that. But as we look at the dividend, our strategy is to basically return our excess cash flow back to our shareholders, and we've actually, the combined dividends and share buybacks, that's been over $2 billion over the last 5 years. And so that strategy won't change. And as we think about the dividend, as Marshall said, what's important for us is to make sure that we have one that's attractive, has a nice yield, 4.5%, more than double the S&P 500. That is, we can grow every year. And as we did with our press release last night, 10% increase. And it's sustainable in the long run, even if we were to get to a point where we become a full taxpayer. So it's important for us to not only have what is considered an attractive dividend today, but one that is sustainable in over the long term.
And then I guess the other part of that is, I think you've said many times that you like between that 3 to 4 times leverage. And then you've done, as you've done a couple times, as that works its way down, you do a mini recap. How does that play in? How do you think about the timing? Does it have to be below 3 for a little ways? And then I guess obviously what's happening in the debt markets and that. But just maybe walk through kind of the process scenario and how you think about that, pull the trigger.
So, right now we're at a very attractive 2.9 times, so we're under 3. We at the end of this year, in January, our 2021 bonds stepped down in terms of their call premium. So we'll look at that point, look at whether or not we could enhance our share repurchase program by taking those out, or whether we do like we did this year, where we grow it by enough to where we wouldn't have too much cash that we couldn't do with that, buy back shares. So this year, if you look at it, we're constrained somewhat by those $800 million bonds. So whether or not we take those out and do something more meaningful or continue like we did this year, we'll take a look at it and look at the markets and make a decision at that point.
But as you think about the cash flow of this company, Marshall touched on this, it's a significant amount of cash flow. And, as you think about our strategy over the last several years, that cash flow has become much more consistent. because as we introduce more season pass holders, that's more of an ongoing, recurring, not only revenue stream, but cash flow stream. And as we continue to invest in these events where we're taking quarters, the fourth quarter just 5 years ago was negative EBITDA. Last year, the fourth quarter generated $66 million of EBITDA. So all of that translates into a very stable, consistent revenue stream, and I think that allows us the ability to look at our leverage over the long-term horizon and adjust that.
One question we've had some discussions with investors is, your strategy here with traditional season pass, the memberships, which, correct me if I'm wrong, the memberships, you get about a 12% premium on that versus on a like-for-like cost.
That's right.
That's right. Yep.
Does that, in a way, could that put you at risk as you're broadening out your demographic, income-wise, potentially a little bit lower, broadening out the demographic there? When an inevitable downturn does come, whenever that is, does that group maybe increase your risk of dropout on the low end? Is that a risk, or how do you guys see that? And I know the other side of it is, well, you've got the international side cranking up also.
Yeah, and as you think about the membership, people say the membership is geared towards lower income folks. We have looked at season pass and membership, and there really is no distinction between those that are buying the season pass and those that are buying the membership. And so we don't look at it and say we have probably a higher risk if the economy was to turn, of losing some of these members. Actually, on the contrary, those are the folks that are paying this on a monthly basis, so it's a little bit more affordable for them. So and then in terms of season pass versus membership, the visitation patterns, the spending patterns in the park are virtually identical between those two groups.
And if there was an economic downturn, or when there is, we provide a tremendous value with our season pass, both on the pass product as well as the membership product. People are going to want to do things with their families, and we provide a very inexpensive, value-packed, entertainment offering.
That's what I mentioned early on in the opening remarks, was that we're somewhat resilient. The regional theme park space is somewhat resilient to downturns in the economy because people look for, as Marshall said, places a little closer to home, a little bit more affordable. It's the whole staycation concept.
And on that 150, 200-mile radius, percent of your customers you pull from?
Yeah, about over 80% of our customer base comes within 150 miles of our park.
Okay. Well, with that, we've got a few minutes left. Any questions from anyone in the audience? Yes, sir. Oh, grab a mic.
Thank you. Could you talk a little bit about what you look for in your international partners, and then also with respect to your international operations, could you tell us how you evaluate the risk that an operator one day in another country causes something to happen where there's a headline that something terrible has happened at a Six Flags park in X country?
So what we look for, well, that's the first part first. What we look for in terms of our partner. And, people ask the question all the time in terms of, why is it such a lengthy process? Well, one of the things is, for us, it's so important, because it's our brand, is to have the right partner in these markets. And that's a partner that understands the true value of, what we can bring in our brand, but also has access to funds. I mentioned earlier that we're not putting any capital into this. So, we look to a partner that has access to the funding that's required, and in many cases has access to the land. And in a lot of these countries, the land is actually owned by the government. So they have to have, access and relationships to be able to get that land. So we go through a very, very detailed process in terms of kind of vetting out these partners. The other thing is we look to, in countries, particularly like in China, we want to make sure that we have one partner for that particular country. So We want to make sure that that partner can actually do, multiple parks. As it relates to the safety aspect, is that we are adamant that we will not do any deal unless we are, after the park is open, we are in there helping our partner manage and run those parks. And so all of the safety specs regarding rides, regarding the procedures within the park come from Six Flags, and we will monitor that on a regular basis. So we take that very seriously, and that's one of the things that we will not compromise on with any of our partners. And if we see a situation where we don't like the way things are running, we have the ability to pull our brand out.
Okay. Any other questions? Gentlemen, any wrap-up comments?
Great. Well, I appreciate everybody taking the time, and as I said, we believe that this is a great investment. Not only do we have, I think, some pretty significant long-term growth opportunities as you think about all of the drivers that have gotten us to where we are today, but on top of that, I think a lot of opportunity, particularly on the international side, and a fantastic dividend yield to boot. So thank you.
Thank you. Appreciate it.